The multiple was 31x trailing revenue, 31 times. If you're a company selling in 2021, you probably did really well, right? Just because the multiples were so high. I think you're seeing in the AI sector some of the same peaks, right? If you wait a year, it's not going to be a White House sector anymore. Because guess what? The all your competitors that would potentially acquire you, the large companies like the IBMs of the world, will, augment their AI force. So they're not going to need your team. So, if you wait a year, your valuation is going to go down significantly.
Hello, everyone. Welcome to another episode of This is M&A. My next guest has been immersed in deal making for decades as a banker, advisor, thought leader, regular featured on Bloomberg TV, Fox Business News. He's also the founder and managing partner at Ascento Capital, a boutique investment bank that he launched in 2017 that's laser focused on technology M&A. Ascento specializes in sell-side mandates for high-growth companies, typically in the 20 to 220 million range. About 90% of their deals are sell-side, with a client base that spans the globe and often involves complex cross-border transactions. What sets his practice apart is a sharp focus on cutting-edge technology companies where the story isn't just EBITDA, it's revenue growth, market disruption, and global scale. And when he's not deep in the deal trenches, you'll likely find him traveling the world with his wife or diving into a great book. With that, everyone, please meet Ben Boissevain.
Oh, thanks for having me, Steve. I appreciate it.
Yes. Great to have you. Just what book are you into now? What are you deep into at the moment? What's on your reading list?
I'm actually trying to revive my German, so I'm reading Grimm's fairy tales, believe it or not, in German. So
kudos to you. Well, happy to have you here. Let's just jump right in. Ultimately, let's talk about some of the topics today. We're going to dive into the clock is ticking and why timing is everything in M&A. And I think over the course of 5 years, we all understand how true that actually is. We're going to unpack and dive into three topics. One, which is market cycles and valuations, why 2021's sky-high multipliers were an outlier, and what today's back to normal valuation means. We're also going to talk about the incubation window, right? Why deals closing now actually started 6+ months ago, and what founders miss if they wait too long. And then the third topic that we hope to dive into, time permitting, is the subsector supply and demand. How being the first mover in your niche can actually mean a premium, right? And why selling late often means you're going to leave some money on the table. So with that being said, Ben, what direction do you want to take this first? Where should we get started?
No, I think that's a great outline. I think the overlying concept is, the founders typically are so engrossed in their day-to-day, right? They're trying to make revenue. They're trying to pay their employees, raise capital. Yeah. It can be all consuming. So the key is to step back a bit and look at your sector and subsector in terms of the deals and M&A and financing and the valuations, and actually the macro economy as well. And a good example in the macro is 2021, right? Which was the pandemic, which was, tough sledding for a lot of companies. But that said, there was amazing deal multiples kicking off there. And I'll just give you one example of Slack, which is acquired by Salesforce.
Who's Slack? Who's Salesforce? I've never heard of those guys.
Right? Yeah. Everybody was into collaboration because everybody's locked in their apartments. How do business, right? Do it through Slack, right? So great. The multiple was 31x trailing revenue, 31 times, which is amazingly high, 31 times, right? So they bought Slack for 31x. There's a lot of other deals that clicked off for very high multiples, right? Now, that said, Slack became an integral part of Salesforce. So was it too high of a valuation? Maybe not, because people use Slack rather extensively. It's like Google buying YouTube for $1 billion. The time was like, that's ridiculous. Now everybody uses YouTube.
Oh, yeah.
It's like a smart acquisition, right?
Slack is sticky. I mean, I probably have 10 tools that have some sort of messenger component to it and does what Slack does, but we all use Slack still. So Slack is the choice.
The standard. Exactly. But, it's good to look at it. So if you're a company selling in 2021, you probably did really well, right? Just because the multiples were so high. Now, they're back to reversion to mean, famous Wall Street phrase, which means that things are going back to quote unquote normal. You're going from, call it, Slack type multiples at the high end to like 6x for revenue, back to like a 4x now, 4 or 5x now, right? So 4 or 5x now is pretty normal on the revenue side. A lot of these companies, as you said at the beginning, are tech companies. They don't really have an EBITDA. They're negative
Right.
in operating profits. So, it's the revenue is the key thing is the multiple, right? So you look at the cycle in the macro, you're looking at the ups and downs, and now we're coming into a cycle. I think that's actually pretty nice time to sell again, right?
Okay.
After a bit of a pause, just because M&A is heating up, boards are more confident. There's a lot of dry powder in private equity,
Oh
which is a
yeah.
good place to hunt.
It's definitely there, and we're starting to see things start to heat up because there's a little more certainty in the world with interest rates coming down and some of the things I'm sure you're going to bring up.
Yeah, no, interest is coming down. There's more dry powder. The hold period is very long for private equity. So what's always interesting is investors have their own investors, right? So, private equity has their LPs, limited partners, and they're getting antsy like, hey, why are you, holding all these portfolio companies, not selling any? So that what's happening is reversion to mean the valuation. So portfolio companies of private equity firms, as an example, they may have bought for 12x, but they have to sell for 6, right? That's just the bottom line, or to get some liquidity in their portfolio, like, a bit like moving around the dice, I'd say to some extent. But so, yeah, so pay attention to the macro economic variables, when to sell. Hard to predict, obviously, but I think we're coming into one of those cycles now where it's pretty favorable.
Well, let me ask you this: have you had a seller who was anchored in 2021 numbers or multipliers that because he was so anchored in it, it might have killed the deal? Have you ran across that yet, or how and how did you handle that? Right.
Well, you always give them the best advice possible. That you can't necessarily anchor at 16 times revenue, even though a competitor of yours, your closest competitor in 2021, sold for 16 times, right?
Right.
Just okay, that was great. Maybe you should have sold then, but that's not the numbers now.
Right.
So you show them comparable companies they're trading in public, right? And look back at Salesforce right now. They're trading for uh, enterprise value revenue of 5.7, which is interesting. Call it 6x.
Right.
So great. Okay. So they bought Slack for a huge amount back then. Now Salesforce trading at 6. They'll probably pay 6 for your company, right?
Right.
So you do
Right.
comparable companies, you do precedent transactions pretty thoroughly and come out with a mean. And that's what typically you go for. Not necessarily, but typically. Sometimes much more than that, because it's not just revenue, it's the technology and the team, right? Which is
Right.
key as well. And sometimes the IP.
Yep.
So that's not a hard, fast rule, but people have to realize that there's a reality test in the market. And it's always interesting in the M&A process because sometimes, they sell for much higher than you expect. I had an auction process where everybody, we had 5 written offers at the table. One was from Taiwan, Germany, Israel, 2 from the US. One was backed by the Riverside partners and a big private equity shop. And their offer was 2x, right? What the other ones were. So it's pretty easy selection process. So you just never know what the valuation is going to be. And the key is to get an auction process to increase the valuation, right? That's the
Right.
essence of it.
There's the saying that history repeats itself. Do you think history is going to repeat itself, and we'll see some of those peak levels, or do you think that's a once in a generational kind of moment?
I think you're seeing in the AI sector some of the same peaks, right?
Right. Right.
AI is super hot right now. Just on with the prospect,
Mm.
and she founded a company that's in AI strategic consulting with some of the top 500 Fortune 500 firms, and the really nitty gritty of actually figuring out the strategy and implementing the strategy. That's the different story, right? It's always easy to say, hey, here's your AI, do a bot, right? But
Right.
actually implementing it, which is really hard to do with LLMs, with RAG,
Yep.
retrieval augmentation, with it's really hard to actually get to the nitty gritty and make it work, right?
Right.
AI. So for enterprise, there's a lot of risk there, but that's what she does, and it's a great sector to be in right now, and the valuation is going to be very high because there's not that many AI engineers,
Yeah.
right?
Yeah.
Very rare. People say they're AI engineers, but are they really? Can they really do, um, enterprise level AI? That's the
That's
distinction there,
interesting.
and do it well, and do it for Fortune 500 and that quality. So she's in a great spot. It's a white hot sector.
Yep.
So her multiples are going to be super high. So that's a good transition, Steve, because you go from like the macro, like 2021, low interest rates, ton of capital floating around looking for deals, hungry buyers. That was the macro level. And now you've got a sector AI when a sector level,
Mm-hmm.
right? Sector level below the macro, which is super hot. So that's always good to look at too. Are you in a white hot sector? If you are, I was telling her on the phone this morning that, if you wait a year, it's not going to be a white hot sector anymore.
Right.
Why? Because guess what? The all your competitors that would potentially acquire you, the large companies like the IBMs of the world, will, augment their AI force. So they're not going to need your team,
Right. Right.
your key asset, right? And there's like 20,000 graduates that are doing AI engineering right now because it's a super white hot sector.
Right.
So, if you wait a year, your valuation's going to go down significantly.
Yeah. I know that's something that really resonated with me when we were talking is you were talking about how important it is to be the first company, not the third or fourth company when trying to time an acquisition or a merger. Talk to me about to the audience about that a bit. The importance of that. What happens when you're not the first person to exit, you're the third or the fourth. What does that do to valuations? How does that change the dynamics of the negotiations, things like that?
Supply and demand, right?
Yeah.
You have a supply of startups doing a certain function, right? You're never alone. You always have competitors. So you say you have 10 startups, and then you have acquirers. And so you have 10 logical acquirers. If you have company, if you track it, and notice that your first competitor got bought. Okay, great. Second competitor got bought. Oh, you know, if you're the fifth one,
Yeah.
what does that mean? It means you have 5 acquirers that already have that capability. So you have 5 less buyers, right? And
Yep.
the valuation goes down because of supply and demand. That's a mathematical function.
Makes sense. Makes sense. Is there something that fifth one can do in their category that can still demand a higher valuation? Is there something that company that you've seen in that position that they've done differently where it challenged that a bit, or has it been pretty fast and it's a hard set rule? It's like, no, normally you're fifth, you're getting chipped away.
Well, maybe there's a desperate buyer out there that doesn't have that capability yet, right? So
Yeah.
they all the targets are disappearing, so they've got the same problem of demand scarcity on their side.
Right.
But it's better, you don't necessarily want to be the first, although it's probably better valuation perspective. The other thing, it takes deals 6 months to gestate,
Right.
so it takes a while. So you're not really seeing, if you look at the market now, it's going to be different in 6 months. But yeah, it's always good to look at the territory.
When that's a good segue into one of the topics, which is that kind of incubation window, right? You're talking about the markets starting to pick up now, but for some of my listeners, maybe they're just now starting to think about it, and typically it takes 6 to 8 months. How do they time that right? You talk to us about that window, how long it takes to close. I've talked to some folks on the data room side, right? They call in, they talk to our sales rep, they're like, oh, we'll be done with this transaction in 3 months. I can tell you from experience in thousands and thousands of deals, it would be the holy grail if it got done in 3 months. 99% of them, it's 6, 8 to 12 months, right? In some examples.
Yeah.
But it's rarely 3 months. And if it is, it's because it's something like, Slack, who was hot to trot, and, it was some unicorn, right? So I guess just talk to us about how long are you finding deals taking right now? Because obviously, some of the uncertainty has created a different deal environment where diligence is taking longer. We're seeing that on the data room side. I'm sure you're seeing it on the deal making side. I guess give some clarity on that.
Yeah, I think it's stretched out a bit, definitely in terms of the timing. So typically we say deals close in 6 months, right? That's a good standard. It can be more, can be less, depending on due diligence. How organized the data room is a great example, right?
Right.
And when they start the data room, I
Yes.
always encourage them to start not even for the deal, but just as part of their operating procedure. Because guess what?
Game
You
changing.
gotta have an organized company, and if you don't have a data room, and you could go by ShareVault's data room list and start that as soon as you start the company. That'd be a
Right.
huge advantage.
It
Just to have
is.
everything in place. Like the cap table is a great example. Like people always have screwed up cap tables because they don't keep track, right?
Right.
It would enforce the discipline to be an organized company. Let's put it that way.
First off, thanks for the shout out. I promise I didn't pay Ben for that, but I
No, it's
appreciate the
true
shout
though.
out. But it is
It's
true.
true. Yeah.
You know, we eat our own dog food, and I use it for all my corporate governance, and I don't know how I would survive without it because it
Yeah.
helps me stay organized. Because if I'm doing these things in Dropbox or Box or some of these other systems, it's a mess. It's hard to go find what you need, and you're stuck when you're actually ready to go to deal readiness. You're spending months just getting prepared.
Yeah.
And
Ex-
you might miss the mark because of that. To your point, sometimes there's windows to what you're doing, and you don't
Yeah.
want to be 3 months late because you weren't ready. So
Yeah.
staying deal ready is huge for us.
Well, you find out, believe me, I hit this all the time. I just got a new client on board, right? Really interesting company. But they have like their documents in 3 different locations, right?
Yeah.
So, to get that all in one repository and organized deal room is going to take a couple of weeks at least, right? So,
Yeah.
so back to 6 months. Yeah, that's a good guesstimate. It can be shorter, it can be longer,
Yeah.
depending how organized the company is, depending on how much, competition you get in the M&A process, how fast the deal takes on the deal making side, right? So it's usually a month to prep, right? You're developing executive summary, target list of buyers, the presentation, the pitch deck, essentially, and then you hit the market. That can take anywhere from 3 to 4 months, and then you got another month of the lawyers coming in, accountants coming in, and closing the deal. But that's
Yeah.
can be very optimistic, and I've done deals in 8 weeks. I've
Well,
done deals in 8 months, so it
yeah.
depends a lot on the deal.
Let's talk about just working back from the 6 month period. You started with month one. You kind of talked about what happens there. Someone like myself, I get solicited all the time. I'm already engaged with a banker. Should I be responding to these solicitations? What's your advice on that front?
Well, you have timing has to be right, right? So you don't want to sell just because you get somebody at a trade show, that's interested, quote unquote, because that may just be a, VP level inquiry, and they may just be trying to suck information out of you as well. So you got to be a little careful there, right? So,
Right.
if there's a genuine, pretty senior interest level hit, then you want to get other people involved, right?
Right.
Other targets involved. And that's one thing banker does really well is beat the bushes for you and make sure that you have competing offers. Because if you don't, you've got very little leverage. If you
Right.
have one offer, it's tough. And the other thing is you'll never know the value of your company. It's a little bit like I give the analogy of you've got a $50 million mansion in Beverly Hills and your neighbor wants to buy you. That's
Right.
great. Fantastic. You got a, neighbor that's interested in buying you. Your neighbor at the trade show wants to buy you. Great.
Yeah.
But, if you get a broker involved, and that's part of what we do, he will beat the bushes, get other people that should be buying your house and have capacity to buy your house, the financial wherewithal, and they'll get them in a competitive situation.
Yeah.
And value will go up. Otherwise you sell to your neighbor, you're never going to know if that was market value.
It's funny. I have a funny story. Just obviously being in the deal enablement business, virtual data room business, we had a client. Most of our clients are like, "Hey, we don't want anybody to know who's in the data room. We want to keep everything locked down on permissions." This guy actually said, "Hey, I want people to see what companies these other people are from," because they were trying to create that competitive environment, right?
That's
They
the
were trying.
approach.
So it
Yeah.
was an interesting approach. He's one of very few that have asked us to do that.
Yeah.
But it was definitely an interesting approach to try to drive that demand and that competitiveness for the deal.
Yeah, it's pretty atypical. It happens sometimes, but sometimes you have a very large cap buyer in your data room, and they don't know who the other buyers are.
Yeah.
Then they kind of assume it's their major competitor, and that can increase valuation too, right?
Right. Oh, interesting. Interesting. So, what are key things that founders should be doing today if they think they might sell in the next year or two?
Yeah, good discipline would be number one, get your data room set up, get organized. That's key. But number two is, take some time to look at the corporate finance environment. And I'll give you an example of that. You should have a list of 10 potential acquirers and 10 competitors.
Man, you'll be surprised. Actually, you're not probably not surprised, but my subscribers probably would be surprised how many founders, CEOs don't have that answer at the tip of their tongue. I've sat in meetings where the CEO was asked who would be the ideal strategic acquirer, and they couldn't answer that question. Like, you should be able to rattle off 10 competitors.
That's a great point. It's great for raising the next round as well as M&A because if your 10 competitors, when they're being bought, right? So you go to
Yeah.
Crunchbase, pick a day, Friday, spend an hour at 4:00 on Friday, look at your 10 competitors, see who's raising around, see who's being bought, and then look at your acquirers, see who they're buying, right? Who are they buying into? What is their strategy, right? And then try to get some connections with the buyers as well. Like at trade shows, walk up, meet the corp dev guy, develop a relationship early,
Right.
right? So when it comes time to sell, the guy to approach, and the operating guy, which department are you going to fit in of an IBM or OpenAI? Which department do you fit, right? And to try to develop a relationship there. Those are invaluable. And then to your point, Steve, if your investors notice you're not focusing on exits, you've got a problem because they're focused on exits,
Right.
right? They're
Right.
putting money into you for a certain hold period. And that period is typically 6 years for PE, VC, venture capital, and it's kind of stretched out to 7 or 8 years now. But it's a certain period of time. They want to know you're focused on exits, right? I
Right.
had a client, great client, semiconductor sector, and he sold for 14 times the revenue, right? In a
Yep.
pretty down market, generally speaking. But he had a hot property. The buyer needed it desperately. So he hired me for 14 times because, I actually was competing against some pretty big banks like Jefferies, but I had my research done by myself. Thank you. And I found one precedent transaction that was 14 times, right? And he goes, I want 14 times. And I go, typically take an average of the precedent transactions, comparable companies. In your case, that's 5x. It's not 14x, but I'll put any number you want on the table. So
Right.
guess what we put on the table? We put 14x.
Of course.
So and he actually every Friday at 4:00, he hired a banker, but he still went through his 10 top competitors and his 10 top buyers, and he knew the corporate finance market very well.
Right.
We take
Yeah.
kind of surround sound approach, not just your operations, but surround sound. What's happening in corporate finance? And it paid off for him very well.
Right. Well, I think what you're signaling to these founders is there's definitely signals that it might be the right time. It might be the right time to sell. Are there any others that we didn't mention that are worthy of mentioning before we move on from kind of the signal side of the topic?
Yeah, one good signal is if you look at Crunchbase, your competitors, and find out that, in extreme cases, all 10 haven't been funded in 2 years.
Right.
They can only go so long without funding, assuming they're not profitable, which most tech companies are not profitable.
Right.
So if they're not profitable, they've got, they need to either raise money or sell, right?
Right.
Typically. So if they're not raising money, they need to sell. So you want to get ahead of that wave. Typically, you don't want to be the only guy, the 10th seller, because then once again, the valuation goes down.
Yeah, makes a lot of sense. Well, just to put a bow around this, we talked a bit about timing and executing deals, That's been a big piece of our conversation. We've seen in the past 5 years a lot of things that shifted how successful deals were. So, the pandemic is a prime example. What's going on today is a prime example. All of those have had impacts on deals, right? We talked about some of the deals that got really great multipliers, but then there's the opposite end where deals didn't happen. Deals weren't happening because supply chain changed, right? Deals didn't happen because interest rates changed, and uncertainty started to happen. There's all these different variables that can impact the deal and the multipliers, the valuations, or even if a deal's just going to get done, right? Word on the street or rule in our world in M&A is time kills deals. So you talked about being deal ready, deal preparedness. Um, it's like you should make sure your house is always buttoned up. Be organized. Don't wait for people to knock on your door. Don't wait for the right timing. Just be deal ready at all times, because you never know when that right strategic, that right opportunity finds you. That's what you want. You want them to find you and give you an offer that's you can't say no to, right? And the only way you do that is you have to send that signal back saying, I'm buttoned up, I'm organized, I have my ducks in a row, I'm ready, let's go. I'm ready. Now, you say, hey, I need 3-4 months to get deal ready. I got to fix my cap table. I need to go fix this over here. My corporate governance is a mess. We haven't updated our corporate handbook in 10 years. And so all of a sudden now you got a bunch of skeletons you got to go figure out, right?
Right.
So that deal readiness is extremely important.
I think deal readiness is a key point, and just knowing the corporate finance landscape and the macro landscape, right? Those are the three different things. Essentially, macro, like what cycle are you in? 2021. I think we're coming into one of those cycles now.
Yeah.
Where it's going to be really good for M&A. I'm not just tooting my own horn here. I really think there's some low interest rates.
Yeah.
There's, people are used to these crises around the world. They're kind of getting used to it. I hate to say it, but it's like, okay, kind of condition normal to have a few wars going on. It has happened for the last couple of years, unfortunately. So it's good timing now. And then if you look at your sector, that's key as well, right? What's happening in your sector? And don't be late. That's the key wrap up.
There's a lot of advisors, investment bankers that would echo that sentiment. They're feeling the market starting to shift a bit here, and timing's great. I could tell you the takeaway that I'm taking from this episode from you is, in my annual planning, I need to bake in some of the things you just talked about. That should be part of my annual planning. Whether we're selling or not, we need to be paying attention to what our competitors are doing. How many sold? How many are getting, merging? What's going on in that space? We do our own SWOT analysis, but this takes it a little layer deeper, right? To make sure that we don't miss our opportunity to understand what the market's doing. So with that being said, I'd like our audience to get to know you a bit on a personal front. Where would you say in your early childhood that you can point to that says, I was going to be in this space, this is what I was going to be doing as an adult? I mean, do you have any early childhood experiences that you can point back to and say, now that I'm in the role I'm in, I get why I was that pesky kid who did this,
Yeah, no, it's a great role. It's like AI is a great example. You're always learning. That's
Right.
the key thing. It's always fascinating what's happening with, AI agents, et cetera. It's really cool. So I was in high school, precocious kid, typical route there. And I had an advisor, and he said, what are you interested in? I go, genetics, genetic scientist sounds cool. International business sounds cool. So I like those two topics. So he actually set up an interview with a NASA scientist that was doing genetics in space with mice, right? To put the mice in space and see how they react, what their behavior was. Very cool stuff, the mice in space. The problem was the guy was completely asocial. He was like, he knew all the names of his rats, and he was talking to his rats and making no eye contact with me. I go, this is a little bit too isolated for me.
Yeah. I've had some people I've ran into where they can't make eye contact, and it throws me completely off.
Yeah.
Yeah.
Yeah, it's interesting. So I thought, well, maybe international business is more exciting, right? So that's the route I picked, luckily.
There you go. Well, it's a good spot to be in. It sounds like you're very similar to myself. I'm a student of business. That's how this podcast came to fruition. Is I generally got interested in mergers, acquisitions, fundraising, everything that happens, from cradle to grave to founding and exiting a company. So we appreciate having you on the podcast. How do people get in touch with you? And why would they want to get in touch with you?
It's always good to explore options at even at an early stage. Happy to advise companies if they're thinking about M&A, a year or two from now, just because there's certain things they can do that will help tweak the valuation to the positive. So happy to do that. The best way, actually, my email just changed. We just got a new URL. It's still Ascento Capital. It's now rebranded Ascento Capital Invest. And the new email, we got a cool URL. I think it's techbanking.com. So
Okay.
it's ben@techbanking.com.
Perfect. And why the change? Why the change on the URL to invest?
I had two companies. So I had Ascento Capital Invest. So I just merged them and got a cool URL. So
Oh,
it's
perfect.
essentially the same company.
Understood. Well, perfect. Well, once again, I'm sure our listeners are going to love this conversation. Thank you so much for being on the show. For my listeners, Ben is also someone you might want to go find on LinkedIn and follow. He shares some good insights there as well. I know regularly he's posting some of the transactions that happened. I pay close attention to that, Ben. It's beneficial for me. I'm sure the subscribers as well. It'll be beneficial to them.
Yeah, just to note, Steve, I've got a weekly newsletter in M&A and tech space, so it's good to follow.
Perfect. Yes. So with that being said, thanks again for joining the podcast.
Great, Steve. Thanks for having me. I appreciate it.
Definitely. So that's a wrap on another episode of This is M&A. I look forward to seeing you all on the next episode. With that being said, until then, stay sharp, stay deal ready.
View and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.